Welcome. In this clip, we continue our discussion of the market for loanable funds. We look at exogenous changes, that is, shocks in savings and investment demand, and their effect on the total investment and the interest rate in the economy. In this clip, I use a somewhat different depiction of the market for loanable funds than in the previous clip. There assume the vertical saving rate, saying that the savings do not depend on the interest rate. But many textbooks use rather a positively sloped savings curve in the market for loanable funds, which is based on the idea that with higher interest rate, households may be more inclined to reduce their consumption and increase their savings. This makes our model more realistic but incompatible with that very simple macroeconomic model on which introductory macroeconomics textbooks are built on. Both changes, shocks in investment and savings, can cause a change in the market for loanable funds. We start with looking at a saving shock. One possible reason for a shock in savings or a supply shock could be a change in the expectations of households regarding their future income. For example, if they expect that an economic recession will start soon, then they are well aware that some of their income will be lost in the future. In order to make up for that lost income, they may start to save more even in the present period so that they will have enough reserves for the hard times. This will appear as an increase in the savings even at the current interest rate. This is depicted here as a rightward shift of the savings curve, resulting in a reduction in interest rate and an increase in the total investments in the economy. Another source of changes in the market for loanable funds are the demand shocks. The demand shocks may be caused by several factors, for example, a change in the government's policy regarding the taxation of investments and firms. Or it is also possible that the firms will change their expectations regarding the future and the profitability of their investments. Let us assume that that is the case for now, and the firms expect that an economic boom will happen soon. That means that the profitability of their investments increases in the near future. So, at the given interest rate, they will be willing to make more investments, and this appears as a rightward shift of the investment demand curve. This results, as you can see on this graph, in an increase in the interest rate, but also an increase in the total investments in the economy. It is very important to note, however, that if we were using the vertical savings curve in the graph, just like we did in the previous clip, then an increase in investment demand would not result in a change in total investments in the economy, and only the interest rate would increase. The next step is to look at the behavior of the government and its impact on the market for loanable funds. Now, we assume that the government decides to increase public spendings without a comparable increase in taxes. This is what we refer to as deficit spending. The public savings were defined as the difference between the tax revenues and the public spendings. Because no public spendings increase without the tax revenue increasing, the public savings must reduce. And this will appear here as a leftward shift of the savings curve. The result is visible on the graph. A higher interest rate with a reduced amount of savings and investments in the economy. So we can say that the budgetary policy of the government will have a direct effect on the amount of investments in the economy and the interest rate. An expansion in government spending will reduce the total amount of investments in the economy. And this is something we call the crowding out effect. And this crowding out effect is a very important phenomenon when you look at the possible effects of fiscal policy.